So good morning, everybody. My name is Colbert Hernandez from SEMBLA. I'll be hosting today's seminar. We are delighted to have with us today Professor Nobuhiro Kiyotaki from Princeton University. Professor Kiyotaki is also an academic consultant at the New York Fed and has holding numerous positions at different universities, the London School of Economics and Political Science, the MIT, University of Minnesota, and University of Wisconsin. Professor Kiyotaki has an impressive record of publications in journals such as the Journal of Political Economy, the American Economic Review, the Review of Economic Studies, Economic Theory, among many others. Professor Kiyotaki has received numerous awards. More recently, he received the Stephen Rose Prize in Financial Economics for his work on financial cycles. And without any further introduction, we welcome Professor Nobuhiro Kiyotaki.
Thank you very much for having me here. And I'd like to talk about my work with Mark Gardner of the New York University. And today's topic, we'd like to talk about the bank run and the financial crisis. It was motivated by recent financial crisis. And as you remember, the financial crisis of this time started summer of 2007. And people start recognizing banks have accumulated loss on subprime loans and related assets like mortgage-backed security. And then financial intermediary starts losing the capital, bank capital, and people get nervous about the bankers. And as you see this picture, the green line is Standard Poor's stock index for the financial sectors. And as you see, it starts going down from the summer of 2007, and especially after the Bear Stearns bailout, it starts dropping sharply. And meanwhile, the spread, this is computed by the Simon Gilchrist and Egon Zakrajcek. This is basically the spread of the corporate bond over the treasury security of the comparable maturities. They did each corporate one by one to match with construct a synthetic treasury security which match exactly the maturity structures and try to see the average spread of the corporate bond over the treasury securities. And you can see before the crisis, the spread is between 1 to 2%. But after the crisis starts, summer of 2007, the spread starts going up. And as the stock market of the financial equity starts going down, and this is, we can consider as a sort of slow runs. People in the Bernanke call it the slow run. The tension starts picking up and the financial sector starts losing money, and the spread between the safe liquid assets versus the illiquid assets, like a corporate bond, starts expanding. But when you look at after the Lehman crisis, the things become more urgent, and you can see the stock price tanks after the Lehman collapse, and also spread starts shooting up. The spread to become as high as 8% annual rate after the Lehman collapse. And before government intervened and the spread starts normalizing. So you can see the this bank run can be the two stage. One is the slow run, which the banker starts losing equity and spread starts expanding. That is before the Lehman. But after the Lehman, the securitized assets market, especially mortgage-backed security market, completely freeze, and the wholesale retail funding starts dropping substantially. And we, as you remember, we enter into the Great Recession. So we try to capture these two stages, slow run as well as the fast run in the model. So that's the purpose of our work. Is it clear? Can you hear me?
Yes, we can hear you clearly.
Okay. So then how do you approach this slow run and fast run? Basically, we try to put together the financial accelerator or credit cycle style model with the rollover risk or the bank run. Here, the rollover risk means the financial intermediary banks rely on short-term financing, and therefore there is always the problem of rolling over the short-term debt. And while they have illiquid assets in the asset side, so there is a difference between the maturity. Asset is longer maturity than the liability, and the asset is illiquid. If every bank try to sell quickly, the price may start going down, while the liability you have to roll over liquid. So there is a maturity mismatch as well as the liquidity mismatch. Asset is long-term as well as illiquid, while the liability is short-term and liquid. And that liquidity mismatch creates the possibility of bank run or rollover risk. And this approach is closer to the emerging economy, like a sovereign debt literature, than traditional diamond diptych style bank run. So it may be more familiar to people in the Latin America. And whether this rollover risk or the weaker run happens or not depend upon the underlying conditions. It's not always happens, and it does depend upon bank leverage ratio, how large the bank rely on the liability instead of the bank equity, as well as how deep is the financial market and how much the asset price collapse when the banker tried to sell the assets quickly. So this both bank leverage ratio as well as liquidation price affect the whether the bank run exists or not. And what we didn't expect, and we only after we analyzed, we discovered is actually even if the bank run or rollover didn't fail, or bank run didn't happen, or rollover didn't fail, just the expectation of the bank run is enough to create the severe recessions. So you don't need the actual bank run or crisis. You actually need only the anticipation of run, which may not happen. That's enough to contract the economy severely. So this is the surprising result we have in this paper.
Professor, and a reminder also for the audience, they can write questions on the chat or they can raise their hands, and I don't know if you want to answer some questions. Thank you.
Please feel free to raise the questions. This is my introduction. Is it okay?
Yes, sure. There is one. There are I'm sorry. Yeah.
To the model, and please feel free to interrupt anytime. So the basic model is a short-run model. So we take the asset supply, this we call it the capital supply, as a given. So K bar is the total supply of the assets or capital stock in the short run. And some of the capital is intermediate by the bank, KB, and some of the capital is intermediate by the household. And maybe the picture is easier to see. Basically, the household has a saving. There are two ways to finance. The household is a saver, business is the borrower. And the household, one way to fund is the household is depositing to the bank. This deposit can be any kind of saving to the financial intermediary. And the banks here is not just traditional bank, but also it includes the investment banks and security companies and all sorts of the financial intermediaries. So one way is the household is going to deposit to the bank or funds, lend money to the banks. And then banker can put together the borrowed money, this deposit together with the net worth, NT. And together they are making loans. Here the making loans, we assume everything is the security financing. We are going to emphasize the financial friction between the banker raising funds from the household. So we are going to ignore the financial friction of business. Typical like a borrowing constraint model is emphasizing the financing constraint of business. But here we know that to focus in the financing constraint of banks, we ignore the financial friction between banks and the business. Effectively, we can think banker owns the business and or banker buy the equity of the business, or the business can pre-commit to pay all the profit to the bankers. So effectively, banker owns the business. And the price of the capital stock, we call it Q, or equity, we call it QT, and the number of stocks or number of capital stock is KT, and held by banker is KBT. So this total funds of the equity purchase, security purchase, is financed by the bank's net worth as well as borrowed money deposit. So this is the indirect finance going through the financial intermediary. But time to time, the household also can lend money directly to the business. This is the direct financing. In the literature, actually this is called direct finance. This is called funding through the bank is called indirect finance. And we assume actually the banker is good at making loans. Therefore, when banker owns the capital stock, they can get all the dividend, ZT plus 1, times the amount of capital stock, and the capital is perfectly durable. So banker is a specialist. They can use the capital or they can make loan to capital very efficiently, while the household is not as good. And so in order to get the same returns, capital stock as well as the dividend, they have to pay the extra cost, FT. This is the extra management fee or the extra goods household have to spend in order to get the same return as a banker. You can think of this as a management fee household have to hire for expertise. And this extra cost is a sort of deadweight loss of doing the direct financing. So if you look at the funding, if the fund ideally, the fund should go through the banks. Indirect finance is more efficient because a banker can make loan without any additional the management fee. Banker himself has their own expertise. But the household try to do the same thing. They have to pay the extra fee. So going through the direct finance is less efficient than the indirect finance. And during the crisis, actually the fund goes less to the banker and more to the direct financing. And the more direct financing, it's less efficient. This feature sometimes called the disintermediation. So funds stop going through the bank, going directly through the capital market. But the household is not as good as a banker. As a result, this extra management fee, extra input is wasted during the crisis or the financial crisis, during the financial crisis. Do you see the main idea?
Yes, so f is a concave function.
Yeah, f is a concave function, increasing and concave function. Therefore, more funds going through the household directly than the less efficient. And that's why the asset price starts going down. If there is no f, then asset price, the asset is as efficient to be intermediate by the household as the bankers. So so the more capital intermediate by the banker, by the household, less funds go through the bankers, the more goods are wasted. And F is increasing as well as convex. Sorry. So this is the basic economy. So either household is trusting the bank and the banker has expertise efficiently intermediating the capital stock, or household have to do it themselves and it's less efficient. And if you solve for what is the banker's way of raising fund? We assume this is the deposit contract. Basically, the banker is borrowing money by deposit contract, which promise to pay the amount R bar T plus 1 at T plus 1. So this is the amount the banker, sorry, it was too small. Yeah. So the banker is promising return R bar, and if there is no bank run, this is the amount banker is going to pay to the depositors. But with run, the banker may not have enough resources. Then the depositor is going to get either the full amount or the realized assets per deposit, whichever smaller amount. If the smaller amount is assets return divided by the deposit, then the loss is shared proportionally to the deposit. There is no sequential service constraint. Often the diamond-Dybvig style model, we have a sequential service constraint, which is if you go early, you get full, and if you go to the bank late, you may not get anything. We don't have such kind of restrictions. Every depositor is going to get equal amount. So in this sense, it's more closer to the rollover risk than the bank run risk due to the sequential service constraint. And at the beginning, we start with a model which the bank run is unanticipated. So the deposit don't think bank run happens in future, and the probability of bank run in future is 0. Later, we are going to make the bank run probability in future to be strictly positive and also endogenous. But it's much easier to describe the economy when the bank run is completely unanticipated. So in this sense, the basic model, the realized return and promised return is the same at the beginning. And only later, we are going to introduce the anticipated situation that the depositor is anticipating the bank run. Is it okay?
Yes, Professor, some of the audience are writing questions on the lower right corner of your screen.
Okay. Yeah.
Thank you.
Modeling bank run. How the decision to model bank run? Yeah. So yes, the Victoria, the household decision is we are going to describe next. And basically, at the margin, the household is going to be indifferent between lending money to the bank, depositing the money, as well as the financing directly. I will describe right now. And here is the household problem. The household is maximizing expected discounted utility of consumption. This is and we assume the period utility is log utility. So that's the utility function of the representative household. And what they are going to use. Part of the fund is used for consumption, CH, and partly they are going to deposit, DT, to the bank. And also part of the fund is saved in the equity. It costs QT per unit, KTH. This is the acquisition cost of the equity, ownership of the capital stock. But when household try to hold equity, they have to spend the management cost fee, F. So this is the deadweight loss for the household to spend. And this is the increasing and the convex function. And it's equal to 0 when its K is 0. How do you finance that? Partly it is financed by the wage. Actually, the wage we assume is proportional to the TFP, ZT, and the WH is the labor endowment. And so this is the wage income of the household. And the other source of the fund is the deposit return from last period. RT is the realized return on deposit, and DT minus 1 is the deposit of the last period. And also the return from the equity holding. Equity they hold from last time is the KHT minus 1, and that generates dividend ZT as well as resale value QT. So the household use the wage and the assets return to finance the consumption and the saving. And the saving includes the management cost. And what's the first order condition? In terms of the deposit, as a basic model, we don't have a bank run. Probability of bank run is 0. So the realized return and the promised return is the same, RT plus 1. And gamma is the marginal rate of substitution between today's consumption and future consumption. And this is the Euler equation for the deposit. How about the Euler equation for the equity? The equity's return is the dividend and the resale value. But what's the cost of acquiring the equity? It's the price of the equity plus the marginal cost. of the marginal management cost. If you buy extra unit of capital stock, it costs Q to acquire, as well as it costs marginally F prime to acquire additional unit of capital to pay for extra management cost, marginal management cost P. And so this is the rate of return of the equity, including the marginal management cost. And this is stochastic because of the ZT plus 1 is random, as well as stock price tomorrow, QT plus 1 is random too. And so the stochastic discount factor is again the marginal rate of substitution between today's consumption and tomorrow's consumption. So this is the Euler equation for the equity. And basically at the margin, they are indifferent to buy the equity or save in the banks or consuming now. So three choice at the margin is indifferent. So except F prime, it is similar to the standard Lucas style asset pricing model. Is it clear?
So far, so good for me.
Yeah. Okay. How about the bankers? The bankers, there are a lot of bankers. Bankers is separate agents actually, distinct from the household. And the banker is going to die with probability 1 minus sigma, and also survive with probability sigma. And this is like a stochastic overlapping generations model, like Blanchard-Yali style. And when the banker exit, and then they are going to consume all the net worth. So, and until then, they don't consume. So banker's life is relatively simple. During the lifetime, they just work and raise the deposit and buy the equities together with the net worth, and they keep doing the business until they exit. And when they exit, they consume everything and die. So it's a bit like our life. You work, and then when you retire, you eat everything and then disappear. So that's the life of the banker. And the banker is risk neutral, so their objective is the discounted utility of future consumption. And the expression is this equation. Basically, the probability sigma IT minus 1, the banker survive until date t plus I minus 1. And then date t plus I for the first time, they exit. At that point, they're going to consume. So this is the probability sigma IT minus 1 and times the sigma minus sigma, 1 minus sigma. This part is the probability of exiting exactly at time t plus I. At that time, they're going to consume. And that's the expected present value of consumption for the banker. You can call this V as the franchise value of the bank. And when the old banker exit and disappear, the new banker come in. And new banker is going to have a initial endowment, WB. And that is the first seed money net worth for the bankers. So new bankers, only the entry time, they're going to have a little endowment. But after that, all the net worth is coming from previous business activity. Basically, the banker is going to use the deposit as well as the net worth to purchase the equities, financing the equities, all the So it's like instead of the loan business, this is all security business. You can think of this bank as the investment banker, which is making loans using the securities. So security financing is financed by either deposit or the net worth. Where the net worth come from? The new guys is a new endowment, but the old bankers, it's the result of the previous business activities. If they lend money B, KBT minus 1, that has a return dividend Z as well as resale value Q. This is the security finance return, total return, including resale value of the security financing from last period. But the deposit, DD plus minus 1, you have to pay the promised return RT. So this is 1 plus deposit interest rate you have to pay. So the gap is the net worth of the bankers. Do you see the life of the bankers?
Yes, one quick question. Bankers then never distribute dividends, they only accumulate wealth.
They are going to accumulate the wealth until they exit. When they exit, they pay the dividend to themselves and
Right.
Retire.
Right, only at the end, and then they consume and then they die.
But at the end of the day, this is very similar to the simple dividend rule. 1 minus sigma fraction of net worth is paid out as a dividend because of the fraction of banker who exit is IID and 1 minus sigma. So 1 minus sigma fraction of net worth is keep paying as a dividend to the retiring bankers.
Thank you. There is another question from Alberto that says, why have that cost of direct financing cover ex ante and increase in function of K?
So this is try to basically we try to think about so you can make this management instead of management cost, you can make the return to be smaller. So actually, initially we tried instead of management cost is paid at day T. Actually, the household has a lower return to get the capital stock. It's like a ZT plus 1 minus F of the KT. So turns out to be if we use the current formulation, it's much easier to compare apple and apple because of now the banker's return and the household's return is identical at DT plus 1. But you can do perfectly similarly if the household is less efficient, if they try to finance the capital stock. And some of you may know my older paper, Credit Cycle. And you can think of the banker as a farmer who is efficient guys and constant return to scale, while the gatherers who is less efficient is decreasing return to scale persons. And instead of doing the decreasing return to scale, what we did is increasing marginal cost of the management fee. So this alpha is a positive, and so this is the increasing marginal cost. So decreasing return and increasing cost is symmetric. And just we use it for convenience to make the return comparable. That's why we choose this formulation.
Thank you. Yes.
Okay, so the deposit and the household choice, and this is the bankers. Yeah, bankers the flow fund constraint or balance sheet constraint. Bankers liability side is a deposit plus net worth, and the net worth is coming from the previous business activity. And the key picture is this one. So basically the date T, the first the TFP shock realized or dividend realized. And the banker is going to, during the period date T, the banker is going to raise deposit and also using the net worth to finance the assets, security financing, QT times KT times KTB. And then during during this period, there are two ways to operate. This is the simple moral hazard. If the banker is honestly operating, the continuation value is a franchise value, VT, expected present value of the dividend. And the next period, they are going to pay the depositor the promised returns and retain the net worth. And they choose, they have either retire or continues, depending on the survival shocks. But the banker can do the monkey business too. So they can actually divert the assets. They can steal the money basically and divert the theta fraction of assets. And the next period, people find out the banker is going to go bankrupt. But at that time, it's too late. Banker actually already eaten the diverted funds and disappears, maybe go to the foreign countries. And so this is the simple moral hazard. Banker is basically subject to the moral hazard of stealing. So they can choose do the honest business, continuing business, or they can divert the fund and disappears. And in order for the banker to do the honest business, you have to satisfy the incentive constraint. And this is the source of the financing constraint. Basically, the banker has to be at least the franchise value, VT, has to be at least as high as the amount of the assets banker can divert. And if this constraint is not satisfied, depositor will lose the money. And therefore, knowing that, depositor is not going to lend too much so that the amount banker can divert become bigger than the franchise value. The franchise value, by the way, is this expected present value of the dividend, this VT. So this is the franchise value at the end of this period. So it starts from next period and at date T. So given today's information, so it's the franchise value at the end of this date T period. And so if this franchise value is big enough amount to divert the assets, then banker is going to do the honest business. And so this incentive constraint is the key constraint. And that's the only constraint, in fact, actually we have the unorthodox constraint. So, sorry. So the incentive constraint is the reason to have the financing constraint. And everything else is relatively kind of common to the other real business cycle model with fixed capital stock. And if you don't have this incentive constraint, all the fund goes to the bank and no fund is wasted for the management cost. Do you have any questions about this? So all model has key assumptions, and the model is going to sink or swim depending on the key assumptions. And this incentive constraint is the key assumptions. Do you have questions?
Yeah, it seems that. Oh,
Is it okay?
yeah.
So please feel free to interrupt when you get. And next one is a bit technical, but please do not worry too much. I just want to give the feel for the value function. And what is the franchise value? Franchise value is either exit in case the banker is going to consume the net worth. But the probability sigma banker continues, that's the continuation value of the next period franchise. Discounted value of that. Remember, banker is risk neutral. That's the today's franchise value. This is the Bellman's equation for the today's franchise. What is the expression for the what is the expression for the banker's value? It's every incentive constraint as well as the budget constraint are both constantly return to scale. So actually, it's convenient to define the value relative to the net worth. So if you divide the franchise value by the net worth, remember the net worth is the net worth is the value from the last period. You can think of this as the mark-to-market value of the balance sheet of the bank, the value in the assets in the market as well as liability in the market. And so N is the mark-to-market replacement cost of the balance sheet of the bank. V is the franchise value. Ratio is sometimes called the Tobin's Q. Tobin's Q is basically the stock market valuation of the corporate value divided by the replacement cost of the capital stock. So this ratio is like a Tobin's Q for this banking franchise. So what is the Tobin's Q? Using this Bellman's equation as well as the budget constraint, what is the Tobin's Q? And the Tobin's Q is the discounted value of the tomorrow's value. If you are the exiting, it's just the consumption value, NT plus 1. While if you continues, the net worth of the tomorrow, NT plus 1, is valued by the tomorrow's Tobin's Q, phi t plus 1. So weighted average is the expected value of the net worth next period. Discounted value of the tomorrow's expected value is the today's Tobin's Q. And what's the growth rate of the net worth? If you don't leverage so the phi t is actually, we call it leverage multiple. How much the assets is bigger relative to the net worth. If you don't borrow money, this leverage multiple is 1. So you don't raise any outside fund like a deposit. You just use, the banker is going to use their own net worth to finance the loans. But if you raise outside fund, it's going to be bigger than 1. So this is the phi leverage multiple. And that leverage multiple will earn the extra returns. This is the rate of return for the bankers. Remember, banker doesn't need any management fee. So banker's acquisition cost of stock is QT and gets the return resale value QT plus 1 and the ZT plus 1. But the deposit return is only RT plus 1. So banker can make money due to this spread. And net worth, if you don't own the equity, you just save the deposit cost. So this is actually using the flow funds rate of return on net worth when banker is choosing the leverage phi t plus 1. And this expression, you can write it down as this way. So basically the deposit cost, nu t is the marginal cost of the deposit for the bankers. And the other factor is extra returns, extra return of assets over the deposit. This is the mu t plus 1. And that multiplied by phi t. This is the leverage multiple. And the banker is basically choosing the leverage multiple to maximize the Tobin's Q, subject to the incentive constraint. Incentive constraint, remember, is the franchise value is less than the amount of the asset banker can divert. And this incentive constraint can be written as the Tobin's Q is at least as big as the assets they can divert per unit of net worth. So this is the amount the banker can divert per unit of net worth. This is the franchise value per unit of net worth. And if you solve these two equations, inequality, as long as excess return is positive, mu t is positive, actually the banker wants to maximize the leverage subject to the incentive constraint. And this becomes equality. And so if you solve that, you can get the simple expression, leverage multiple, assets relative to the net worth, is the Tobin's Q divided by the theta, because of this is the inequalities. And then plugging into the expression here, you can see the leverage, endogenous leverage multiple is the simple expression like this. This is the formula Gertler and Peter Carradi derived earlier paper. The top is the marginal cost of the deposit. Bottom is the amount banker can divert minus the marginal, the extra money, the excess return of the capital stock. You can see the leverage multiple is a decreasing function of theta. So more banker is subject to the moral hazard, leverage is lower. And also it's an increasing function of mu, which is the more excess returns, banker's franchise value is bigger, and the banker is, people feel safer because of the banker's franchise value is bigger. So for the detail, please look at the paper, but I hope the intuition is relatively clear. But at the end of the day, this is basically the banker's endogenous leverage multiple assets to the net worth ratio is a simple function of the underlying parameter and endogenous variable. And what is the aggregate conditions? Aggregate condition is the banker's net worth, aggregate net worth times the endogenously chosen leverage multiple is the amount banker can finance. So this is like a financing constraint of banker is generating to the credit channels. Basically, the amount banker can finance depend upon their net worth, and this is the amount the banker can finance. And the rest of the capital stock is financed by the household. And what is the aggregate net worth? The continuing banker's net worth is the result of the previous returns. Sigma fraction survives. But the 1 minus sigma fraction is a newcomer. They bring in some new endowment. So that's the evolution of the aggregate net worth of the banker. And the goods market clearing condition is basically the consumption of household and the consumption of banker, which is the exiting banker's dividend payout, and plus the extra management fee That's the consumption plus this management cost is financed by the return on capital stock and return on labor and endowment new banker is bringing in. Okay. What about the bank runs? Here, as I said, the probability of bank run is ex ante considered to be 0, but ex post, the depositor may stop rolling over the deposit. We call it bank run. And then when the depositor stop rolling over the deposit, banker has to sell the assets. And when they start selling the assets, asset price starts falling. The price is no longer Q. Actually, the liquidation price Q star, which I'm going to describe how determined in the market. And so if the bankers is actually the liability to the depositors is bigger than the returns on capital, when the banker have to sell all the assets to the household, then the banker is going to go bankrupt. Basically, this is the simple multiple equilibrium argument. If no depositor worry about banks, and therefore they continue to roll over the deposit, banker doesn't have to sell the assets, and the price is high enough so that this is the other equality. So banker's asset is enough to cover the deposit liabilities. But if the household starts worrying about banks and they stop rolling over, banker have to sell the assets, and asset price drop enough, Q star is dropping enough, then banker is going to go bankrupt. How the asset price is determined? This is the expressions. If the banker is going to go bankrupt, at day T, no new banker can come in. So all the asset is going to go into the household. The household is going to hold entire assets supply. But next period, the new banker starts coming in. This is the new bankers at day T. And also the day T new banker is going to enter only next period. This is the simple assumptions actually. Basically, we assume during the bank run crisis, actually the new banker cannot get into the business because of the depositor cannot distinguish between new and old. And so new banker enter only one period later. This is only technical assumptions. We don't need it, but it's convenient to make sure that the T period, bank run period, all the assets is held by the household. But after the crisis is over, the new bankers net worth is going to be the continuing bankers' return and the new bankers' endowment. So the evolution of net worth of the bank is the. Do you have questions? Sorry. Okay. So the new banker is the net worth. New banker's net worth is this one. But there are new bankers who are supposed to get in last period, and they enter only if they survive. If they don't survive, they just eat their net worth. So that's why we have two group of new banker only at 80+1. Afterwards, new banker is always the 1 minus sigma fraction. So that's why we have a slightly asymmetric expressions. If we have a date T new banker can come in, their net worth NT should be the same as this one. The 1 minus sigma to the WB, omega B. Does this answer question? Oh. So basically, during the crisis, bank run, no new banker come in. Then after the crisis, the new bankers, as well as bankers who are supposed to get in at 80 enters with their endowment. And after that, 2 periods later, all the net worths go back to the normal, continuing bankers return and new bankers return. And what is the asset price? The banker is going to slowly recovering, but meanwhile the household holds this asset. So the entire capital stock is held by the household, and this expression asset price is basically we solve from the household's first order condition. We basically iterate households the Euler equations for the equity Lucas asset pricing model to compute the asset price, and the house bankers' net worth is small, their ability to buy the asset is low, and all the rest of the asset has to be financed by the household. And therefore, during the bank run, the entire household asset is held by the household. But the next period, banker starts coming in, and after that, the banker starts accumulating the returns, and that will change the fraction of assets held by the household. Okay. And let me give you some quantitative feel. This is the simple numerical example. And we basically use the relatively standard discount rate. This is a quarterly model. So it's like a 99.99 means 1% per quarter interest rate, or it's like the 4% real interest rate. And also, the productivity shock is serially correlated with 95% quarterly correlations. And some of the variable, like fraction of assets you can steal, theta, or the banker's survival rate, or the banker's new banker's endowment is unorthodox parameters. So how do we choose? Sigma, concerning the sigma, we choose the 95%, which means the 5% of banker exit and replaced by the new banker every period. This is like a dividend payout is roughly 5% per quarter of net worth, or 20% of the net worth, which is probably not so outrageous relative to the data. And the seizure rate, amount you can steal, or the new banker's endowment, actually we try to hit the two targets. One target is the leverage multiple. So leverage multiple, we choose 10. Basically, assets of the banker is 10 times as big as the net worth. Another target we choose is the spread. Assets return is the banker's return is 5% annual, and while the deposit return is 4%. Therefore, the annual spread is actually 1%. This is a steady state value, and there is not much equity premium in the log utility, as you know from the equity premium puzzle literature. So assets return for the household for the equity and deposit is comparable, while the banker is earning the substantial spread, and because of they don't have to pay the marginal management cost. So this 1% spread and 10 leverage multiple is the target to choose two key free parameters: seizure rate theta and the banker's new banker's endowment.
One quick question, Professor. The KH and KB, do they reflect direct and indirect finance data, or are chosen differently?
This is only kind of we just think the steady state roughly 30% is financed by the household and 70% is financed by the banker. So we try to make sure there are enough room that the bankers is going to finance the majority of financing in our economy.
Thank you.
So, but the target was the leverage multiple and the spread.
Okay.
Please, this is only numerical example, not the serious calibration to the real economy.
Thank you.
And this is the baseline shocks. We are going to have a productivity shock of 5%. So 5% productivity shock, slowly decaying, that's the Z. And then what is going to happen? When the productivity shock hits, the banker is going to lose the net worth, and the banker is going to shrink. This is the, oops, sorry, going the other way. So the logic goes through this. So if you have a productivity shock, Z shock, the bankers lose the net worth. But when banker lose the net worth, the banker's ability to finance goes down. So, and the KB starts going down, which means the household have to absorb more capital stock. But the household is not good at financing capital stock. Therefore, the Q starts going down. Asset price starts falling. Asset price starts falling, the banker loses the net worth even more. And if banker has a big debt obligations, which cannot be covered by the new endowment or dividend, actually the lowering Q, the asset price drop is a bad news for the banker. Despite Q is falling, net worth is falling faster due to the debt overhang. Debt obligation exceeds the dividend. Then if the price go down by say few percent, the banker's net worth drop more than the same percent. As a result, banker have to shrink more. This is the logic of credit cycle. Basically, when the banker has outstanding debt overhang, lower price hurts the banker more than helping, and the bankers' demand for asset become decreasing function of asset price. Unlike usual demand, the demand is increasing with price, decreasing price. Actually, demand is increasing function of price. Or if price drops, the demand starts going down instead of increasing. So that happens here. So when the productivity shock hits, the net worth go down, and the asset price go down. But the asset price go down, net worth go down more than asset price. Asset price drops by about 5 to 6%, but the net worth is dropping like 50% because of the leverage. Leverage multiple was 10, and asset net worth dropped like 50%. As a result, their demand is going down despite of the asset prices falling. That will makes the allocation less efficient. So their bank size dropped by 25%, and the household size has to go up, and they have to pay more extra management cost. As a result, the Y output net of the management cost. Output is constant completely exogenous due to the productivity shock and no elastic labor supply. But this output is the output net of the management cost. That is dropping more than 5%, you can see. But this credit cycle style propagation is not too big if the underlying shock is the productivity shock. So actually the output dropped like a 6% instead of 5. So gap is the propagation through the balance sheet channel of the bank. So we do get the modest propagations, but if you don't have a bank run, the situation is not so bad. But if you have a bank run, situation is very different. So what happened is here. So this run variable is actually the shortage of the coverage by the banker. Sorry. Basically, when the bank run happens, how much the return is smaller relative to the deposit obligations if we evaluate the price as a liquidation price. Remember, liquidation price is under the condition of bank run. Banker is temporarily wiped out and a new banker slowly taking over. During that period, the household hold the majority of assets. That's why asset price is low. And if that happens, so this run variable is basically how much there is a shortfall of assets return in the event of the bank run. And we choose the parameter so that the bank run never exists in a steady state. So if there is no negative productivity shock, the banker, even the bank run happens, the banker can still cover all the deposit obligation from the assets return. But if there is a negative shocks, then the bank run become possibility because of there is a 2% shortage of the total return over the deposit obligations. Then the bank run become possibilities. And then this example is after the one period shock, date 2, the bank run happens. At this point, all the banks are wiped out, and the net worth dropped to 0, and slowly the new banker starts coming in, and the output is now dropping like a 10% instead of 6%, and also asset price drops not just 5% but 15%, 13%. So you can see if you have a actual bank run happens, the asset price drops more, and also the output drops more, and we got the severe recessions. And you can see the spread also shoots up, like bank's rate of return and the deposit return is actually shooting up. So without bank run, we have a standard, without bank run, we have a standard financial propagations, credit cycle style propagation. That is the red dotted curve as a reference. But the extra bank run is going to generate the severe recessions and the slow recovery because of temporarily the banker is wiped out and takes a while to recapitalize through the new entry. And
yes, Professor, one question. One key ingredient in these dynamics must be the functional form, the F cost that the household incurs. How do we think about this F? Is that inefficiencies that come from the screening process on what investments to fund, or how do we think about that?
Yeah. So the the cost of the management is basically the screening cost of the loans, and the expert like a banker can do the screening with their own skills, but the household have to they hired some expert. Basically, the curvature and size of the management fee is going to determine how deep is the market and how much the asset price drops if the banker starts selling the assets and the household have to absorb the assets. You can think of this as a non-expert returns. If this is instead of household, you can think of this is selling to the foreigners who doesn't have a expertise in the domestic financing market. So yes, the F is the key to determine how much the asset price drops. And so far, we assume the probability of bank run is 0. But if we have a bank run time to time, the household should expect bank run is possible in the future. So this is the key extension we make. Basically, the people observe, anticipate the bank run is possible in future. And the bank run happens. If there is no bank run, deposit realized return is the promised return, R bar. But if bank run happens, the total returns of the bank give the with the liquidity liquidation price, evaluating liquidation price Q star divided by the deposit obligation. This is sometimes called the coverage ratio. So how much the bank's assets return covers the deposit obligations. And partly asset is financed by the net worth. So if there is no bank run and Q star is not that Q is high enough, then there is no problem of covering 100%. But during the crisis, Q star is substantially lower than the normal price. So coverage can be not 100%. If coverage is 100%, it's 1, then there is no bank run. Bank run, no bank run have the same returns, and nobody has to worry about bank run. But the coverage in the event of bank run and the liquidation price Q star is low enough, and then the coverage is not 100%. And then the realized return is going to be less than RT plus 1. And what is the probability of bank run? The normal case, ideally, we want to endogenize the probability of bank run as like a dynamic, the global game. But the global game in dynamics turns out to be very notoriously difficult. So we did a little shortcut. Basically, we assume the probability of bank run is somewhat related to the shortage of coverage. This is the expected shortfall of the coverage. If the coverage is 100%, XT plus 1 is always 1, then people don't expect any bank run. But the expected shortfall is positive, then probability of bank run is positive. And we are going to use the simple linear form of the expectation of bank run. And this is the reduced form, kind of cheap and cheerful way of doing the reduced form global game. And what we got from here is the depositor has to be compensated for the expectation of the bank run. If you don't have a bank run, 1 minus P probability, then the return is the same as the promised return. And this is the marginal rate of substitutions. But if you have a bank run, PT, then the return is the promised return times the coverage rate, XT plus 1. And also the marginal rate of substitution is no longer the same as the non-crisis time. Consumption will be different. So for the detail, please look at the paper. But what its amount is basically the franchise value per unit of net worth, Tobin's Q for the bank, is now modified. Basically, they are going to earn the extra returns if and only if they are going to survive. If there is a bank run and they don't survive, the franchise becomes zero. So the discount is become now the proportional to the probability of survival. And also the promised return R bar is no longer the same as is going to be affected by the probability of bank runs and the coverage ratio. So everything becomes endogenous. At the end of the day, what happened is even if the bank run didn't happen, just the P starts going up and the probability of bank run gets bigger, what happens is the Tobin's Q starts falling because of the franchise value is going down. And therefore, the people start not trusting these bankers. So leverage starts going down because of the franchise value is no longer that high. You remember what happened to the Lehman when the Lehman survival during the early September, when Lehman survival was in doubt, the franchise value, stock market value starts falling. On top of that, the banker stopped lending because of the franchise is the collateral, and they start lending less to the bankers, the Lehmans. That's we try to capture here. And also, if the Lehman have to pay the higher interest rate, then the net worth starts going down more quickly because of the net worth is the return of assets minus the deposit returns. So this guy starts if the banker have to pay higher interest rate, they have to keep paying higher interest rate. As a result, spread starts going down, and also that hurts. So actually, just the increasing likelihood of bank run itself is creating the serious contraction. We can show it in this diagram. You can see, and this diagram is the endogenous probability of run. And when we have a negative productivity shock, the same 5% productivity shock, the probability of bank run is going up to the 2%. You see the bank run probability. I shouldn't go too big. Yeah. So the probability of bank run is going up by 2%, and the red dotted line is the same as the figure 1. Basically, people never expect the bank run, just the pure financial accelerator through the bank's balance sheet. So you can see that case, the output loss is 6%, and the bank contraction is a little over 20%. But when people start expecting the bank run, because of the coverage rate is no longer 100% due to the negative productivity shock, then the bankers have to start paying the higher interest rate, and net worth starts going down, and the asset price goes down more. You can see the asset price is dropping like 70% instead of 50%, and the net worth dropped by 80% instead of 50%, and the bank size dropped like 60% instead of 25%, and the output drops like 8% instead of the 6%. You can see the endogenous bank run possibility will make the contraction more severe. And this is even without actual bank run happens. Actually, the probability of bank run is now positive. and but the bank run didn't happen yet. But nonetheless, people are expecting bank run because of the coverage is no longer 100% due to the negative productivity shock. And then you can see the propagation is bigger than the without anticipating the bank run. But the final picture is this one. This is the combining the anticipated run together with actual run. So what happened here is the probability of bank run go up by 2%, and then actual bank run happens in the fourth quarter. So then initially the contraction is just anticipation of bank run, but if you have an actual bank run, the banker is going to be wiped out at this point, and net worth is wiped out, and the asset price drops like substantially, like 15%, and the output drops like 10%. So after actual bank run, we are going to have a very slow recovery because net worth takes long time to recover. This net worth process is the one we describe here. Actual bank run happens, the temporary banker is wiped out, and slowly new bankers start taking over. And so if we see it, without actual bank run, the probability of bank run go up. It has a significant contractionary effect. But on top of that, actual bank run happens date T, date 4, the contraction is severe and the recovery is very slow. If we use this picture model combined with the data, previous data, this is the credit spread. This spread is coming from Gilchrist and Zakrajcek. This time, instead of total spread, we use something called excess bond premium. Basically, the bond premium, which is not explained by the default of the borrowers. It's supposed to reflect the lending part, the bond premium, which is not explained by the borrower's default, but the lender's constraint. And this spread is going up into the 2% after the Lehman crisis. But initially, the spread starts creeping up, and the bear stance collapse is the one triggers. And what we did is the productivity shock hits at the same time as the bear stance crisis. And so this is our model. And then Lehman time is the actual crisis. This is a period of the slow crisis. Basically, people are anticipating crisis, but the crisis hasn't happened yet. But then Lehman moment is the actual crisis. Actual bank run happens. And so this point, the bankers' stock market collapse and the spread starts shooting up. But after that, the new banker starts taking over, and eventually spread starts coming down, as well as the equity starts coming down. So this bottom is the bank's equity value, our franchise value. So when the negative shock hits, even if bank run doesn't happen, anticipation of bank run is enough to reduce the franchise value, and whereas increasing the spread. But then actual bank run happens in the Lehman moment. The temporary bankers go all our model, simple model. This is a systemic risk. Every banker go bankrupt, and then franchise value temporarily becomes 0, and the spread shoots up to 2.5%. And then after that, the banker starts coming back through the new entries. The reason probably our spread takes longer time to recover is that we didn't have a intervention of the central bankers or the government. So basically, by combining the usual financial accelerator together with anticipated loss, we can characterize slow run followed by the fast run, like a Lehman shock. Perhaps we should say something about, before closing, we should say something about the public policies. Should I make remark? So, do you have any questions? Oh. Okay. So the try to say something about the policy. Basically the concerning the bank run, standard policy is the deposit insurance. But turns out to be our economy, the deposit insurance is actually the dangerous because the banker may divert the assets. So if the banker's moral hazard is a problem, deposit insurance is not the solution. Then standard solution is two ways. One is the more capital requirement. What is the capital requirement? Basically, the capital requirement is try to reduce the leverage more than natural limit. Natural limit of leverage is the this incentive constraint. So the basically the leverage is the determined by the incentive constraint of diverting assets. But the government can put a restriction which the leverage to be less than the natural upper bound for the financing constraint of the bank to be binding. So that will reduce the likelihood of the bank run. But at the same time, the household is less efficient. Therefore, if banker's size drops, actually the more resource has to be spent for the extra management cost, and therefore, actually the intermediation costs go up and the economy size gets smaller. There is therefore the trade-off between the stability of financial system and the steady state efficiency of the financial system. And that's the ex-ante interventions. Ex-post intervention is that during the crisis, the government intervene to buy the assets. Even if government may be as inefficient as household to pay the extra management fee, it may be still worth doing that to stop asset price from falling. Basically, instead of household holding entire assets, the government is going to absorb some of the assets. As a result, the household doesn't have to hold so much assets, and asset price didn't have to drop as much. And but the problem of ex post lender of last resort, or the lender of last resort for the market interventions, is basically anticipating the government intervention during the crisis. The leverage may be higher. As a result, the financial accelerator gets bigger. So the lender of last resort is going to makes the leverage multiple bigger. As a result, the financial accelerator is higher. So you have to combine the capital requirement. So my suggestion is the central banker have to intervene ex post during the crisis. At the same time, they have to intervene ex ante to limit the leverage multiple, or put this more tougher capital requirement. That's two combinations, ex ante as well as ex post combination, you have to intervene. You have to use. That's my suggestions and learning from this model. Thank you very much.
I have a
Do you
quick
have more
question,
questions?
Professor, regarding your policy recommendation with government intervention exposed. What guarantees that the inefficiency function F of the government is not even more increasing than the households inefficiency function?
Actually, even if the government is even less efficient than household, actually still the buying assets with a loss, actually the
That's right.
Basically, even if the government is less efficient than household, it is beneficial to intervene in a small scale to support the liquidation price. That will reduce the likelihood of run. But of course, if the F is huge for the government, government end up losing money. So the capacity to lose money is also problem. So some of the countries, they try to intervene, but the government has a limited financial capacity. Then they cannot intervene in the big time. And does this answer your question?
Yes, thank you. I don't know if there are more questions from the audience.
So the basic recommendation is ex ante capital requirement as well as ex post intervention as the lender of last resort. And you have to combine both to find the better allocation of resources. And the trade-off does depend upon how inefficient is the government in interventions ex post, and how inefficient is the household when the government tries to restrict the size of the financial sector.
Yes, one last question, Professor. This is regarding the flight to quality effect that we often see. What guarantees that households will actually buy and then they wouldn't fly to a safe asset, treasuries or something?
Yeah, right now the household choice is either bank's deposit as well as the equity, buying equity. Both are risky during the crisis, actually. And if the household has alternative choice, like holding the foreign, the treasury securities, then the bank run become more likely, actually, because of the household is going to use their limited fund to buy the equity, and equity price can really tank. So capital flight or the flight to liquidity, it makes the rollover risk even bigger.
Well, thank you. If there are no more questions, I would like to thank Professor Kiyotaki for this very insightful seminar. And I would like to remind the audience that on October 20th, we have Douglas Laxton from the IMF presenting a financial crisis in DSG models. And thank you, Professor. It's been a pleasure.
Thank you very much for
Thank you.
having me here.
Thank you.